Hey guys, welcome back to part 3 of the Momentum Funding Trading course. Today, we're going to be discussing fundamentals and sentiment. Now, for those of you that want to dive in even deeper, make sure you get the Trading Bible PDF. You can get it in Momentum's Discord or by signing up on Momentum's email list. I'll leave that in the description below. Now, I'm going to talk about how the fundamentals works, what drives price, and I'm going to basically show you a couple of tools I use to do this. The one's completely free. The other ones, it is paid. If you take trading seriously and you can afford it, I would recommend it because it turns 2 hours a day of research down into 5 to 10 minutes, maybe 15. What you see on the screen in front of me here, this is the economy in a whole. So we're just going to talk about the US dollar. And the reason for that is, as beginner traders, I want you guys to mostly focus on US majors. As you get a little bit of experience, I feel like at that point you can dive into assets like gold, US 30, NASDAQ. I don't recommend that for beginners traders. Now, if you already have, 6 months, a year and a half experience, you'll likely have an easier time with those assets than someone who just started on day one. The quickest way to discourage yourself in trading is to start off with gold or indices. I'm not saying you can't do it. I'm just saying don't do it in the beginning until you learn a little bit about the market, because they're a little different pairs than your average currency pairs. So what drives a currency, and essentially which currencies really affect the markets, what I want to touch on. So this is really going to come down to you guys. What currency pairs am I trading is going to determine which news you need to follow. Now, if you're a beginner or intermediate or advanced, I recommend you stick to one pair, two max. Most people that try to look at 5 or 10 pairs just get confused and don't know what's going on and don't make money. I know very few people that are capable of trading that many pairs successfully. Most people I know that are profitable traders trade one pair, maybe two. I think I literally know one person that looks at everything under the sun, and the reason he does it is he built tools to monitor the market for him that'll scan the whole market and basically tell him which two instruments he should look at for the day, and at that point he only looks at 2 anyway. But he's a very advanced trader. If you guys here watching this course, you're not. So let's talk about what actually moves price. Right now, one of the main things that we're dealing with is inflation, and one of the main things that we're looking at is interest rate and jobs. So we're only gonna talk about the US dollar for now because that's the most important currency. That's the world reserve currency that ultimately drives the market. So what happens in terms of, let's say you have US dollar here and you have euro dollar here. If you have a country that's raising their interest rates and the other one's lowering their interest rates, let's say the US dollar has higher interest rates and the euro dollar has lower interest rates, that makes the US dollar stronger and that makes the euro dollar weaker. So the country that's raising rates is going to be taking money from the country that's lowering rates. So that's the very simplistic way of putting it and learning it. There are some discrepancies to this, but that's way above and beyond what most of you are going to be learning here. There may be a time we get to that, but not right now. So think of it this way. US has high rates, euro has low rates. US dollar is going up, euro is going down. So as interest rates go down, the currency basically loses strength. As interest rates rise, the currency gains strength. So that's kind of the basics of interest rates. Interest rates control how much investment's coming into the country, how much growth there is, how much a company's basically willing to borrow. So you got to think of how companies operate. When Apple wants to invest $200 billion, Apple doesn't burn through $200 billion of cash. Apple will take a $200 billion loan and they'll use that to expand. Why? Because interest has no taxes, and essentially inflation keeps rising, meaning their debt's actually getting chewed up by inflation. So companies don't use their own capital to expand, they use debt. When do these companies like borrowing money? When the interest rates are coming down. When the interest rates are just coming up, the currency is really strong, people are buying money, people are buying stocks, but the company doesn't necessarily want to expand borrowing a bunch of money because it's too expensive to borrow. So they'll wait till the interest rates come down, they'll start borrowing a bunch of money, and as the economy gets better, interest rates rise, they're making money. That's essentially the cycle. So interest rates is the first one. Next, you have CPI. So CPI since the pandemic has been, it's basically taken this long to come down. In the last, 4 or 5 years, inflation got out of control. What did every country do? They raised interest rates. What did that do? That slowed down inflation. When you get the interest rates way too high though, companies stop expanding, stop hiring, and eventually it gets to the point where these companies start laying off. So what the Fed does, or any central bank, is they monitor jobs, they monitor inflation. And their job is to have lowest inflation possible, highest jobs possible. They achieve this via interest rates. That's their most common tool. They have a few other tools, but we're just going to talk about interest rates. So right now we have a scenario where Trump wants the Fed to cut interest rates. The Fed doesn't want to. The reason the Fed's not in a hurry to cut interest rates is because while jobs are declining, they're declining at a very low rate. Whereas if jobs just went off the charts and they came way down, the Fed would cut right away to save the job market. They don't have to do that because the job market's fairly stable. Inflation's at 2.3, as you can see on my chart right now. The chart is coming down. Trump's basically saying inflation's good enough, you guys should cut rates. The Fed's coming back and saying you have all these tariffs. The back end of these tariffs could cause inflation problems, and if we cut too soon, inflation could get out of control again. And if inflation gets out of control, the Fed's gonna have no choice but to make a choice. Are we controlling inflation, or do we want to save jobs? They won't be able to do both. So right now, both are in somewhat of a decent place. So the Fed keeps repeating, we're well anchored, we're well positioned, we're not in a hurry to cut. So I hope that kind of ties in how the interest rates, the jobs, and the inflation correlates. That's kind of the three big ones you need to pay attention in terms of what drives the economy. Now, right now, US's GDP is coming down. That makes a lot of sense. Companies are laying off. Trump's got all these tariffs. In April, USA had 20% less imports than the month before. Again, all these tariffs. The GDP is expected to come down. This is part of the natural cycle. This is everything we've seen before. ISM manufacturing and PMI, or ISM manufacturing and ISM services, they're two different measurements. Services measures how well the services industry is performing, so your restaurants and stuff like that. Manufacturing is obviously things like steel manufacturing and that. So you can see the numbers on my screen. We have ISM manufacturing PMI 48.7, and then services is at 51.6. What does this mean? So 50 is the median. If the numbers are above 50, it means the industries are expanding. If the numbers are below 50, the industries are contracting. If the Fed's doing their job correctly, we should be staying very close to that 50 and kind of riding that wave. What we don't want to see is ISM manufacturing or services drop to 40% or something like that, because now that means the industries are declining and they're laying off, and the GDP is going to come out low. So the Fed's going to start using their tools to bring those both back into balance. This comes back to interest rates. This comes back to controlling inflation, because anytime we want to expand and we want the economy to expand, everybody relies on borrowed money. For people to borrow money, interest rates have to be low. No one's going to borrow large amounts of money when interest rates are out of control. So it's kind of like the boom and bust cycle. You have to time things right, and you're going to learn in this course and in the market that everything comes down to timing. It's about doing the right thing at the right time. So that's kind of the ones I'm going to touch on. So we've touched on jobs, we've touched on CPI, we've touched on interest rates, and briefly we touched on GDP and ISM, services and manufacturing. Everything else, consumer sentiment, that's essentially how much consumers are spending, and that is ultimately what's going to drive the economy as well. So if Apple puts out a bunch of products, but the basic consumers aren't making money, the economy is going to do this. GDP is going to do this. So the Fed has to make it so companies can make money and people can make money. Retail sales is kind of ties in with the consumer sentiment index. Unemployment, the big one you're going to be looking at is NFP. You're going to see a lot of other stuff like JOLTS, job openings, and unemployment claims every week. Those are important, but they're less severe. Let's kind of talk about the other tool we use, and this one is called Forex Factory. This is free. You can see there's a lot of red folder news. Now, a lot of people are going to tell you don't trade red folder news. Probably not horrible advice. What I want you to understand is different red folders hit different. So here I have USD unemployment claims. This probably isn't going to do much unless the numbers are completely out of whack. Whereas the numbers are completely out of whack, then it's going to do a lot. So what do I mean by that? See, at the top we have the previous report we have the forecast, and we have the actual. Previous report means the last release. So if we look at the last unemployment release, 229K people were unemployed. The forecast was 230K, so the unemployment wasn't really expected to go up a lot. And it actually came out to 227K. What that means is the number was so close to what was expected, it's not going to have a big impact in the market. So if I see something like this, I would have no problems trading that right away. Now, where it's going to have a big impact is, let's say the last month or the last release was 229K, and this release comes out, the forecast was 230, but then this comes out and it's only 190K jobs. Well, that means the job market's doing way worse than expected. The analysts were way off on the forecast, and this is gonna hurt the dollar bad and spike the safe havens right away. This is way out of whack. This automatically changes my sentiment or bias for the day, and I'm gonna try to follow it. So when the numbers are greatly out of whack, it's a big deal. Now, which numbers do we compare? I like the previous report, and I like the actual release date. Actual, factual numbers. What is a forecast? Forecast is what an analyst predicts that it could be. So essentially, it's not that relevant of a number. Hard data numbers are important. Predictions are just predictions. So I hope that kind of makes sense. So when I'm looking at the things to look at, NFP is important, CPI is important right now while inflation is a problem, and I'll basically consider stuff like that. Interest rates is important. Powell talking is important, whereas a lot of the other red folders have a lot less weight. They won't really do much unless the numbers are completely out of whack. So I hope that makes sense that not all red folders hold the same weight. With that being said, I don't recommend having open risk during news. Wait till after the release, do your assessment, decide if you want to participate. So that's kind of the basics of red folder news. You're gonna have yellow folder news and orange folder news. I don't pay any attention to them. I don't care about them. If you want to dive into them, I think it's a lot of unnecessary information that's not gonna help you ultimately make a lot of money in the long run. So it's best to just focus on the big stuff that moves the economy. So that's kind of the quick overview of fundamentals. Again, if you get the Trading Bible, I dive way deeper into fundamentals in more detail. You can learn more about it. Now, let's dive into sentiment. If you have access to MarketEdge AI, I'll link my coupon down below. You can have 10% off. They were nice enough to provide Momentum's guys 10% off. If you have the capital, I recommend getting this. If you don't, there are free tools such as Twitter, a bunch of random Telegram groups that provide a lot of this information for free. However, you'll probably have to source all of this information from 4 or 5 different places. And ultimately, it might take your focus away and you might get the information too late. And it takes a lot more time. So on this tool specifically, and again, if you can't use the tool, go source the Instagram groups, go follow the right Twitter stuff, and create a free source of informational flow for yourself. It's doable. I did it for a few years, and then ultimately I started using different AI tools, this being the best one I found out of all of my tried. So what is sentiment? Sentiment is how do the investors feel about the market? What changes sentiment? The investors want to know if they feel safe or if the market's risky. If the investors feel safe, money pours into stocks, equities, stuff like that. If the investors feel that the market's very risky, the money is going to pour into safe havens. Your safe havens being gold, the Japanese yen, the Swiss franc. Depending on the situation, sometimes gold will perform well, sometimes the other two will perform well. Sometimes the market loses confidence in fiat altogether and runs to the shiny metal, which is gold. So what does that mean for you as a trader? What is sentiment? What causes different neutral sentiments, risk on environments and risk off environments? Risk on means you're buying equities. Risk off means you're buying safe havens. So what fuels these movements if we're not talking about red folder news? Well, right now we have a very volatile president, and every time he sends a tweet or he speaks, if it has an important message regarding any kind of conflicts, Russia-Ukraine conflicts, Israel-Hamas conflict. The new one right now is China is talking about military action with Taiwan. Anytime these scenarios happen and let's say military action gets taken, Usually oil spikes, gold spikes, and people start pulling money out of the stock market and putting it into safe havens. Now you have a risk-off environment. The market doesn't feel as safe. What else can cause the market to feel unsafe? Trade wars. So things like tariffs. So every time Trump creates some kind of announcement, I'm going to put 100% tariffs on China, dollar crashes, safe havens such as gold will spike. So these are the investor sentiments. And a lot of the time, the sentiment is what's actually going to drive price. So overall, right now, the market has a positive outlook. Why? Trump doesn't want to start any wars. Trump wants to negotiate everything through peace, through trade deals. If that happens, really good. Strong US dollar and weaker safe havens. Now, if Trump proposes that and the other countries don't choose to follow it, and ultimately the trade wars continue or the actual conflict wars continue, the investors are going to change where they want to put their money. So this tool's made it really simple. Right now we have a neutral outlook because everything's mixed. If, let's say, Russia and Ukraine sign this peace deal and Trump gets the trade deal done with India, gets the trade deal done with Japan, this will likely come down here to somewhere around active buying and active risk taking. So now the sentiment is the money's pouring into equities. So your US 30, your NASDAQ, your SPX, stuff like that. That's how the investor sentiment would drive in. Your job as the trader is to look at the fundamentals, look at the sentiment, and then you're going to look at the chart, be like, hey, I'm bullish on gold on fundamentals, I'm bullish on gold on sentiment, and I'm bullish on gold on the chart. All three are bullish. What's my highest probability setup? It's going to be buys. Or hey, the gold chart's actually bearish, which it is right now. Overall market outlook right now is kind of neutral, but more on the optimistic side. That's kind of bearish, not the strongest bearish, but kind of bearish. And the fundamentals are gold are kind of non-existent right now because we're talking about rate cuts, but the rate cuts have been priced in. There's really no serious fundamental drive at this current moment on gold. So I'm really leaning to sentiment, and I'm really leaning to if my technicals line up with the sentiment. So that's how the bias comes along. Now, if you can see what our risk-off environment's caused by, sector rotation, tariff uncertainty, mixed economic data. So right now it's very mixed. Some stuff's bullish, some stuff's bearish. Sometimes these markets are good to sit out for a day or two and wait for it to get more one-sided. It makes it easier to get a bias and it protects your capital. And Fed policy speculation. So right now, the future interest rate decision by the Fed is basically saying we're happy where we are. We'll eventually cut, but not yet. So that's going to provide a sentiment. Now, if Powell came out and spoke on Monday and said, hey, things are not looking good, we got to cut, the whole sentiment for the market would be like, let's get ready for this cut. And ultimately, we're counting on a weaker dollar right away. So the other thing I like about this tool is, let's say you trade USD CAD. Oh, by the way, if you're trading to, let's say USD CAD is your trading pair, you would follow USD's news, you would follow the Canadian news. Those are the two news that matter for that currency pair. You don't need to wonder what the Japanese yen's doing. You don't need to follow the Swiss franc. That's the currencies you're gonna follow. So if I click on this, once again, this is gonna do my analysis. I don't need to follow anything. This is kind of the way I like to do it. Actually, I don't know if it'll do it today because the market's actually closed. It's Saturday. So it did it for gold here. So 1 hour trend, slightly bearish. Daily trend, slightly bearish. Weekly trend, slightly bullish. What is my sentiment? We have the data, we have the safe haven appeal, we have the geopolitics, we have the technicals, we have the volatility. Overall, gold is kind of neutral, maybe leaning towards sells a tiny bit. Not the greatest setup, not the worst setup, but maybe it's I set a day out and wait for more. So that's why sentiment's so important. That's why it's good to be able to formulate a bias before I look at the chart. So this whole week for gold, before I even looked at the chart, I had a bearish bias. I had a bearish bias via sentiment, via fundamentals, since the rate cut's already been priced in. Even if they cut rates, 25 basis points is not going to do much. Now, if Powell surprises and cuts 50 basis points, that's going to do a lot more because the market hasn't priced that in. So there's always about what's expected and what actually happens. And that's ultimately what market sentiment is. So I know this one's been probably a bit more boring, but this is a necessary boring we have to talk about, because if you can't get this stuff right, it won't matter what kind of technicals you'll learn. You'll never understand the big picture. And if you want to follow the big money and how they move the markets, you got to follow the big picture, because they aren't sitting on the 1 minute chart or the 5 minute or the 15 minute or the 1 hour. They're not even sitting on the technicals being like, well, I'm riding the 1 hour MA. No, they're going to be like, hey, we have a 200 MA on the weekly that's bullish. We're going to follow that. And they're going to wait for sentiment, and they're going to wait for fundamentals to align with that. Then they'll start buying. If you're seeing a bunch of sells on gold, that's likely profit taking, repositioning. And for us in retail, we're like, oh, we're bearish for 3 weeks. We catch that. A big hedge fund might be like, I'm going to take profits here and I'm going to ultimately keep adding to my buy positions. That's what the long-term bias is. But yeah, I think I've covered everything I wanted to cover in this section, guys. Ultimately, we're going to start doing more of the chart stuff starting in part 4, part 5. Part 4 is going to be market conditions. Part 5, we're going to talk about ranges and directional bias on technicals. So I hope to see you guys in the next part of the videos. I know part 2 and part 3 wasn't that exciting, but it was necessary. Now that we got that stuff down, we can move on to the other stuff you guys are all waiting on. All right, guys, I will see you in the next part.